Hi, welcome to Stock Story. Today we're going to talk about discounted cash flow calculator. But to start with, just want to make sure you remember that Stock Story is for education and entertainment. It is not financial advice. It gives you a spot to start doing your own research on. Please do your own due diligence before investing, and if needed be, seek out a professional financial advisor. So as I said, today we're going to do the discounted cash flow calculator. And for me, this is probably the most important thing. When you look at the stock market, you look at stocks, we can't control what's going to happen next in the earnings. We can do our best estimates. Same thing for a lot of things. We don't know what news is coming up. We don't know if something odd's going to happen with the management. But the one thing that we have some control over is what price that we actually buy a stock at. And so as in The Intelligent Investor, Ben Graham talks about Mr. Market, and basically saying Mr. Market's like your business partner. It comes in with a different price all the time. It goes up and down, and we all know about the stock market fluctuating, but you only have to buy when you get the right price, something that makes sense to the balance or the book value of the company as well as the earnings power of the company. So when we're looking at this one, we have it looks at the earnings, the growth, and the balance sheet. You have the choice of choosing the balance sheet if you want or not. I always think it's important because the assets are part of the company value. The other thing is it discounts a safe return, so it puts a discount in there. I know with Guru Focus, they put in the sort of averages that people have could make off the market indexes. I prefer to go with the absolute safe return of a guaranteed investment. Right now in Canada, that's a GIC for 5 years is, I don't know, 2 to 2.5%. So I discount at 5% when I'm doing it. And anyways, the result of this, it'll give what's considered a fair price for a stock, and then you can see whether it's selling at a discount to that price or whether it's a little on the expensive side, and then you can make your decision on whether or not to buy. Okay, so this is an example of Universal Insurance Holdings, which is a company that I do hold, and it gives an example of how the discounted cash value calculator shows up here. And so I'm going to just go over here. Right here you have the earnings per share. Now this can be interchanged with cash flow per share as well. It defaults to earnings per share, so I usually stay with that. But I do check and see if the earnings and the cash flows are similar. If they are, I'm fine. If not, I have to go into the cash flow statement and find out why. If it's just a one-time thing or if it's just an anomaly, that's fine. But I just want to make sure I've uncovered that as well. It also looks at this over a period of 10 years. You can change that. Also, it shows the growth rate over on this side, which it shows 19.3. It's got a terminal growth rate. Oh, I've put this in at 0, but it actually defaults. I'm going to just refresh this. Let's take a second here. Anyways, it actually has a terminal growth rate of 4% usually. Here we go. And then the earnings are coming in. Yeah, so it actually has 19.3 for the growth rate for the next 10 years, and then running out for 10 more years, it says 4% growth rate, and there it goes, the amount of years for terminal growth rate, and then it's got a discount rate of 12%, which is what Guru Focus has averaged as returns from the market over a long period of time. On the other side over here, it gives you the tangible book value, and it gives you the opportunity to add it to the fair price that you're calculating. So I do some changes on these particular calculations. The first thing is I don't want to know about growth, because to me, growth is it's an estimate. It's not something you know for sure. You can look at past growth, and you can maybe make some estimates on that. But I want to know at this particular moment the book value plus what it's earning now over 10 years, what that actually is worth as far as a stock price. And so because of that, I don't actually do the terminal growth either. I'm not looking at 20 years. I'm looking at what it's worth to me in 10 years from now. Even then, I probably don't know if I'd be holding it for 10 years or not, that sort of thing. And as I said before, I go with a GIC in Canada, which maybe at top end might be 2.5% for 5 years. So for 10 years, I would be able to make 5%. So I'm going to discount it. It's going to divide the number by 5% just to discount the value. So when interest rates are high, you can get a GIC with a high interest rate. It means that it's probably a pretty good investment. Like way back in the 80s when they had interest rates of, I think mortgages were up around 18%, you probably could get a pretty high rate on a GIC that would match at least market history. So you probably the risk you take on buying equities would not be worth as much as it is today in this low interest environment. So right now, by using a lower discount rate, it ups the value of the particular equity. So anyways, so I've done those pieces, and you can see right now the margin of safety is right here. It's minus 9%. But when I add the fair value of when I add the tangible book value to it, we now have a margin of safety. So this price is actually under by 23%. And then I would look and see, has the company been growing? Does it look like it have catalysts to help it grow? And if it does, then that makes me feel even better. But even if it was just holding flat, this would seem like a fairly good purchase because you're getting it at a discount. And that's, one of the things that I really want to focus on is that's something I have control over. I can buy this at a fair price. If it was the other way around and it was a negative number in there, then it's a high price. And even if the stock has been going up, I know that I'm taking on some risk because I'm buying on speculation that the earnings are going to do really well and grow into that overvaluation. Now we're looking at Microsoft here, and when I look at Microsoft's fair value, I'm just going to make sure that we got the right, it's the financial data for Microsoft. You can see right now that it shows that it's overvalued. Now, it has been growing the cloud. A lot of people believe that the cloud business is exceptional for them, and I agree it is, and I always have thought Microsoft is a great company, but at this price I wouldn't buy it. Now, this is with some growth and stuff put in. Actually, if you I'm going to refresh it again because I've been playing with this before. So if I refresh it and get it to where they have their terminal growth rate too, now you can see the margin of safety is minus 180, and this is with a 5% growth rate estimated based on past years. They're actually growing faster now, which is good, but this higher growth does have to make up quite a bit of ground because the margin of safety is actually not margin of safety, it's a margin of risk really of minus 180. And then if you take my way of doing it, which is I don't like to factor in the growth. I'll look at growth as a part of determining whether I buy or not, but I'm not looking at buying something that's overpriced based on the speculation that it's going to grow that much. So anyways, I knock all those to zero. I go to my 5% discount rate, and it's 289%. I'll add in the book value to the fair value, and I guess it's to minus 180. So it works out to about the same. But right now, this stock would be too expensive for me. One of the things, I'm just going to pull this down here. When you look here, so this is the stock price here, right there, 62.74 right now. So the fair value, according to this calculation, is right here. It's 22.43. And so if it did become 22.43, I would be perfectly happy to get into Microsoft, even if it got to 25, 24, even under $30, I might consider it because of the growth that they have, because of the growing dividend they have, the stable balance sheet, and everything else. But right now, 180% is just a little too much of a premium to pay for the stock. So all of this information is in an article in stockstory.ca. I'll have the link for that down below, as well as I'll have a link for GuruFocus, the value investing website that I use for most of my analysis, as well as a link to StockStory where I review GuruFocus and talk a little more about what you can do on it. One of the things I wanted to point out, though, is when I wrote this article, I used to use the growth. Used to use the growth, as you can see here. It was for this one, it was Apple, and it was 20%. And I used to use that, but I really want to focus on not speculating and spending more time buying value that is as it is now rather than what I think the future will be. I can look a little into the future, but only if I've already got pretty close to current value at this particular time. And for companies that don't know as well, then I would actually want even a bigger margin of safety on the current time, because their growth may be less predictable than other ones. Anyways, thanks for watching, and look forward to seeing you again. Please share this, subscribe. If you have any comments, questions, please put them down below. I look forward to talking to you. See you next time.